On February 28, 2022, 2 days after the G7 announced the freeze on Russian sovereign reserves, a question circulated through the People's Bank of China's internal research division. The question was not whether a similar freeze could be applied to China. That answer was already obvious. The question was more specific. Of China's $3.2 trillion in foreign exchange reserves, exactly how much was held in custodial accounts controlled by Western institutions, and therefore vulnerable to the same mechanism used against Russia? The answer they arrived at was uncomfortable. Approximately 45 to 50% of China's total reserves, somewhere between $1.4 and $1.6 trillion, was held in instruments, accounts, and custodial systems that the United States and its allies could theoretically target in a coordinated sanctions action, not because China had been careless. Because the dollar-centric financial system is structured in a way that makes avoiding Western custodial exposure nearly impossible for any major economy that participates in global trade. The custody problem is not a policy failure. It is an architectural feature of the system that has been in place for decades and that every central bank has quietly accepted as the cost of participating in the global economy. What happened next, beginning in the spring of 2022 and continuing systematically through 2024, is the largest sovereign reserve repositioning in modern financial history. China began moving money, not all of it and not quickly, because moving it too quickly would cause its own damage, but persistently and at a scale that no other government has attempted in the modern financial era. Every month that passed, the number that Western sanctions planners could put on a freeze order got a little smaller. This is the story of how China has been systematically shrinking the target, and what it means for the most powerful financial weapon America has ever built. To understand what China is doing, you first need to understand exactly why Russia's reserves were vulnerable in the way they were. The $300 billion that the G7 froze in February 2022 was not cash sitting in Russian accounts in the traditional sense. It was sovereign wealth held in the form of securities, government bonds, agency paper, structured deposits, custodied by Western financial institutions. The largest single custodian was Euroclear, the Belgian-based infrastructure company that acts as the world's primary cross-border securities settlement system, processing over 800 trillion euros in transactions annually. Euroclear was holding approximately 230 billion euros in Russian assets when the freeze happened. It did not seize those assets. It did not transfer them to someone else. It simply stopped processing transactions. Russia retained legal title to every security in those accounts. But the custodian, the institution that physically operated the plumbing of the account, was in Belgium, subject to European law, and was told by European regulators to freeze. Legal ownership without custodial access is worthless. Russia learned this in a single weekend. China's analysts understood this architecture better than most Western observers realized. The custody problem is not unique to Russia. It applies to every country that holds reserves in securities issued and custodied in Western financial systems. China's own reserves were overwhelmingly held in exactly this format. US Treasury bonds, the single largest component of China's reserve holdings at the time, are issued by the US government, settled through the Federal Reserve and the Fedwire security system, and custodied by institutions that operate under US jurisdiction. European government bonds are custodied at Euroclear and similar European institutions. If the United States and its allies wanted to freeze Chinese reserve holdings, the mechanism was not theoretical. It had already been demonstrated at scale. Russia was the proof of concept that the architecture works, and that legal ownership means nothing when the custodian is in someone else's jurisdiction. China's response came in two simultaneous tracks. The first was gold. The second was a quiet multi-year program of reducing the percentage of its reserves held in Western custodial systems, moving money from institutions that could be instructed to freeze it to assets and systems that cannot be reached by a swift message or a US Treasury order. Both tracks began in earnest in the second half of 2022. Neither received the attention they deserved in Western financial media, which was focused on the immediate drama of Russian sanctions enforcement and the short-term trajectory of the Russian economy. The gold track has been the more visible of the two, though even it has been systematically obscured. China's central bank reported gold purchases for 18 consecutive months beginning in late 2022, the longest unbroken buying streak in the People's Bank of China's recorded history. Official reported holdings grew from approximately 1,948 tons in October 2022 to over 2,300 tons by mid-2024. If those official numbers are taken at face value, China spent roughly $50 to $60 billion accumulating gold over that period. But there are strong and well-documented reasons to believe the official numbers significantly understate the actual position. China has a consistent documented pattern of underreporting gold purchases and then making large upward revisions to its official holdings at irregular intervals. In 2009, China announced that its gold holdings had jumped from 600 tons to 1,054 tons, a 454-ton increase that it said had been accumulated over 6 years without any of it appearing in monthly IMF reports during that period. In 2015, it revealed another significant upward revision to its stated holdings. The pattern is not accidental. China does not want to move the global gold market during its accumulation phase, so it buys through channels that do not always appear in central bank reports, through state-owned commercial banks, through sovereign wealth vehicles that are not classified as central bank holdings, and through entities whose purchases are not captured by standard IMF data collection. Independent analysts who track Shanghai Gold Exchange withdrawal data, global mining output figures, and documented import flows from gold-producing countries in Africa, Australia, and South America estimate that China's actual gold holdings may be anywhere from 3,500 to 5,000 tons, roughly double to triple the official published figure. The People's Bank of China may have built the world's second or third largest gold reserve, while its published data suggests it holds significantly less. At 2,300 tons of officially acknowledged gold, using the April 2024 price of approximately $2,400 per troy ounce, China's reported holdings are worth roughly $177 billion. If the real figure is 4,000 tons, the value approaches $310 billion. And unlike the US Treasuries held in the Federal Reserve's custody system, every ounce of gold sitting in vaults in Beijing, Shanghai, and domestic Chinese storage locations cannot be frozen by a SWIFT message. It cannot be blocked by a US Treasury order. It cannot be accessed through Western custodial infrastructure because it is not in Western custodial infrastructure. It is physical metal, held domestically, that maintains value in any currency and can be traded bilaterally with any counterparty willing to accept it. Russia demonstrated this directly in 2022. Its domestic gold reserves, unlike its foreign custodial holdings, remained fully accessible and usable throughout the sanctions period, serving as collateral for bilateral trade with India, China, Turkey, and Gulf states. The history of gold repatriation as a geopolitical signal is older than China's current program. In 2013, Germany made an announcement that sent a quiet shock through central banking circles globally. Germany said it wanted to repatriate 300 tons of its gold from the Federal Reserve Bank of New York and 150 tons from the Banque de France back to Frankfurt. Germany had stored gold in New York since the Cold War, when Western European central banks wanted their reserves physically distant from Soviet forces near the eastern border. By 2013, that rationale had expired decades earlier. Germany asked for its gold back. The Federal Reserve's response became something of a legend in central banking circles. It told Germany the process would take 7 years because the gold needed to be melted, assayed, and recast into bars meeting Bundesbank specifications. 7 years. To move metal that Germany legally owned from a vault in Lower Manhattan, 17 blocks from the New York Federal Reserve's public entrance. That exchange reverberated through every central bank that was paying attention. The question it raised was not comfortable. If Germany, one of the United States' closest strategic allies, a founding NATO member, home to major American military installations, could not retrieve its own legally owned property quickly from New York, what did that imply for countries whose relationship with Washington was considerably less warm? China drew its own conclusions and moved faster and more quietly than Germany. Rather than requesting repatriation of gold already lodged with the Bank of England or the Federal Reserve, China's strategy was to ensure that all new gold purchases went directly into domestic vaults, and that its custodial exposure to Western depositories was reduced through non-reinvestment as existing arrangements matured. Physical custody, China concluded, was everything. Legal title without physical access was a claim that could be politely honored over 7 years, or indefinitely delayed. The second track, the reduction of US Treasury holdings, is well documented because the US Treasury Department publishes monthly data on foreign holdings of American government debt. In November 2013, China held $1.3 trillion in US Treasury securities, making it the world's largest foreign creditor of the United States, larger even than Japan. By mid-2024, that figure had fallen to approximately $770 to $800 billion. That is a reduction of roughly $500 billion over a decade. Measured as the longest sustained exit from US government debt by a major foreign holder, it is without precedent in the history of the Treasury market. No single country has reduced its exposure to US Treasuries on this scale over this time period while maintaining a functioning trade relationship with the United States. The exit was not linear. There were months and even quarters when China added to its treasury holdings, typically in periods when it needed to manage the yuan's exchange rate by purchasing dollars and then parking those dollars in the safest available dollar-denominated asset. But the overall direction, measured from the November 2013 peak to the current position, is unmistakable. $500 billion of US Treasury exposure has been quietly removed from China's balance sheet over a decade. The money did not evaporate. It was repositioned into assets held domestically, outside Western custodial systems, or denominated in currencies that fall outside American sanctions architecture. Why didn't China sell its treasury holdings faster? This reveals the structural trap at the center of the repositioning story. China cannot exit US treasuries rapidly without causing substantial damage to itself in the process. The US Treasury market, while the deepest and most liquid government bond market in the world, is not infinitely deep. If China attempted to sell several $100 billion in treasuries over a compressed time period, the selling pressure would drive treasury prices down and yields up. That means the value of China's remaining holdings would fall before it could complete the exit. It is a variant of the prisoner's dilemma. China is large enough that its own selling disrupts the market it is trying to exit. Rapid selling would also be read as an act of financial aggression, potentially triggering a crisis in the bilateral relationship before any Taiwan confrontation that China presumably does not want. The only viable strategy is gradual, patient reduction, allowing bonds to mature and not reinvesting the proceeds. This is precisely what China has been executing. When a treasury bond matures, the holder receives the principal in dollars. The holder can choose to reinvest those dollars in a new treasury bond, maintaining the same level of exposure, or deploy the dollars elsewhere, reducing the position. China has been systematically choosing not to fully reinvest at an accelerating rate since 2022. Each maturity that is not rolled over is a reduction in exposure with no secondary market disruption, no price impact, and no geopolitical signal that might be read as a hostile act. Over a 5 to 10 year period, this strategy converts $500 billion in treasury exposure into alternative assets without a single day of market drama. It is the quietest and most effective form of strategic repositioning available to a sovereign investor of China's scale. Where did the repositioned money go? Gold absorbed the most visible portion. Beyond gold, the repositioning took several forms. Yuan-denominated assets held domestically, Chinese government bonds, policy bank instruments and securities issued under Chinese law and held in Chinese custodial systems, cannot be frozen through Western financial architecture because they are entirely outside it. An American or European sanctions order targeting Chinese financial assets has no mechanism to reach an instrument that is issued, settled and held exclusively within China's domestic financial system. Non-Western currency holdings have also grown. Chinese reserves now include more Japanese yen, Swiss francs and the currencies of major Belt and Road partner countries, particularly in the Gulf and Southeast Asia, where bilateral trade arrangements generate returns in local currencies. Belt and Road loan receivables denominated in yuan, the over $1 trillion in infrastructure financing extended to developing countries since 2013, generate interest and principal repayments that flow back to Chinese state banks in yuan, creating a return stream that never touches dollar clearing systems. China's gold buying program triggered something that no Western financial authority anticipated, a global central bank accumulation wave that has fundamentally altered the supply-demand dynamics of the gold market. In 2022, central banks around the world collectively purchased 1,082 tons of gold, the highest annual purchase volume on record, nearly double the annual average of the preceding decade. In 2023, purchases remained near record levels. The buyers were not primarily China. They were Turkey, India, Poland, Singapore, Qatar, Kazakhstan, Uzbekistan, the Czech Republic, Hungary, and dozens of other central banks that drew their own conclusions from watching Russia's reserves freeze in real time. The lesson spread instantly and universally. Reserves held in Western custodial systems are conditional. If your government's foreign policy diverges sharply enough from what Washington considers acceptable, the legal ownership of those reserves does not protect you from being locked out of them. Every government with any exposure to geopolitical risk received that calculation in February 2022. Most of them acted on it by buying gold. The gold market responded exactly as economic logic predicted. Prices climbed steadily as central bank demand absorbed new supply, and then broke through $2,400 per troy ounce in April 2024, a new all-time high. The irony is precise and worth stating clearly. The sanctions action against Russia that was intended to demonstrate the overwhelming and unchallengeable power of Western financial architecture instead triggered a global repricing of the one major asset class that sits entirely outside that architecture. Central banks moved toward gold. Dollar-denominated reserves in Western custodial systems became comparatively less attractive at the margin. The action produced a reaction that worked against the strategic objective of the action. The weapon demonstrated its power and simultaneously accelerated the construction of the shield. The United States has not been passive in the face of China's repositioning. The primary American counter has been a pre-commitment coordination effort, working with European allies and financial partners to agree in advance on the structure of a China sanctions package, so that if a Taiwan scenario materializes, the financial response can be triggered immediately without the negotiation delays that sometimes weaken coordinated actions. The theory is strategically sound. If Europe commits to the framework before a crisis, the speed and completeness of the financial response is maximized, and China has less time to react before the noose tightens. The practice is considerably more complicated. Germany, France, and the Netherlands, the European countries most deeply exposed to China through trade, manufacturing supply chains, and automotive revenue, have been deeply reluctant to make binding pre-commitments on sanctions that would cause them severe economic pain that they can see clearly from the Russia precedent. Pre-commitment to a financial war against China is easy to agree to in a bilateral meeting with Washington. It is very difficult to maintain when the actual cost arrives on a German automobile company's quarterly earnings call. There are limits to what China's repositioning can accomplish, and precision about those limits matters. China cannot become sanctions-proof. Approximately $780 billion in US Treasuries still sits in accounts subject to American jurisdiction. China's major state-owned banks, the Industrial and Commercial Bank of China, China Construction Bank, still depend on dollar clearing for a significant portion of international trade finance. CITAMS handles approximately $50 billion per day, which is real but still a fraction of the several trillion-dollar SWIFT processes daily. The technology choke points, advanced semiconductor equipment, chip designs, software tools, are not addressed by gold purchases or treasury reductions. The vulnerabilities are real. The repositioning reduces them. It does not eliminate them. What the repositioning accomplishes is specific and measurable. It reduces the expected damage from a nuclear financial option strike. In early 2022, the estimated damage was $1.5 to $1.6 trillion in assets that could be frozen or blocked within days of a coordinated sanctions order. If the repositioning has reduced the freezable exposure to $1.2 trillion or below, and the arithmetic of documented gold purchases, treasury reductions, and custodial shifts suggests it has moved meaningfully in that direction, the immediate damage from a freeze is still severe. But the magnitude of the shock is smaller. The ratio of what can be frozen to what cannot has shifted. And China's capacity to absorb the remaining shock has grown with every new CIPIS connection, every UN oil settlement, and every Belt and Road infrastructure loan that routes economic activity outside dollar clearing systems. China is not trying to win the financial war before the critical window. It is trying to ensure that by the time the window arrives, the cost of pulling the trigger has risen high enough that the option remains theoretical rather than actual. Every ton of gold in Beijing's vaults is a message. Every treasury bond that matures without being reinvested is a message. Every yuan barrel of oil that clears through CIPS instead of SWIFT is the same message. You built the most powerful financial weapon in history. We have spent 3 years making it more expensive to use. The target is smaller than it was in February 2022, and we are not done. India is watching China's repositioning closely and running a parallel program at smaller scale. India is the world's fifth largest economy, the third largest oil importer, and a country with its own set of geopolitical vulnerabilities that the Russia freeze made suddenly concrete. India's central bank, the Reserve Bank of India, brought over 100 tons of gold back from the Bank of England's vaults in 2024, the largest repatriation since 1991, when India physically airlifted gold to London to secure an emergency IMF loan during its balance of payments crisis. That the country that once airlifted gold to London as collateral is now demanding that same gold back is not a small symbolic shift. India's domestic gold holdings now exceed 600 tons for the first time in its history. Like China, India is buying gold consistently and bringing it home. The lesson of February 2022 does not require translation. It is visible in the monthly data of every central bank that holds reserves in Western custodial systems and has any reason to fear geopolitical friction with the United States. The logistics of what China is doing deserve more attention than they typically receive because the scale of the operation is genuinely without precedent. Moving $500 billion in reserves from Western custody to domestic or non-Western holdings is not a transaction. It is a sustained institutional operation involving thousands of individual decisions, which bonds to allow to mature, which custodians to exit, which alternative assets to acquire, at what pace, through which channels and with what transparency to the IMF reporting system. The People's Bank of China's Foreign Exchange Management Department, working in coordination with the State Administration of Foreign Exchange and the sovereign wealth apparatus of the China Investment Corporation, is executing the most complex reserve diversification operation in the history of central banking. And it is doing so while simultaneously managing the yuan's exchange rate, supporting Chinese financial institutions through a real estate sector correction, and financing Belt and Road lending programs across more than 100 countries. The operational complexity is staggering. The fact that it has proceeded with minimal public visibility in Western financial media is itself evidence of how effectively China has managed the information environment around the strategy. The question that analysts at the US Treasury and at Federal Reserve research divisions have been quietly wrestling with since 2022 is this: at what point does China's repositioning cross a threshold where the nuclear financial option becomes genuinely less useful rather than just marginally less powerful? The answer is not a clean number. It depends on the state of China's bypass infrastructure at the moment of use. How many CIPES participants are online? How many countries have yuan settlement agreements? How deep the gold for trade mechanisms have become? But working backward from the damaged models, most analysts agree that the option loses meaningful deterrent power when China's freezable exposure falls below roughly $800 billion and when its bypass payment infrastructure reaches a volume where 50 to 60% of its essential trade can continue despite a swift cutoff. Neither threshold has been crossed, but both are visibly moving in China's direction with every passing quarter. The timeline that governs everything is 2027. That is the date that US defense and intelligence officials have publicly cited as the year Chinese military planners were told to be ready for a Taiwan action if required by political circumstances. It is also the date that frames all of China's preparation, financial, military, technological, as a race against a specific window. If the nuclear financial option needs to be fully priced and committed before any conflict begins, and if the European pre-commitment framework requires another 2 to 3 years of diplomatic work to solidify, then the years between now and 2027 are the last years in which China's repositioning can close the gap between where the strategy is today and where it needs to be. China cannot afford to still be repositioning when the window arrives. It needs the repositioning to be substantially complete, not perfect, not total, but complete enough that the damage calculus has shifted. That urgency explains why the pace of gold purchases accelerated after 2022 rather than moderating. The clock is not abstract. It is tied to a specific geopolitical timeline that both sides understand. What China's repositioning does not solve is the technology dependency. Gold cannot replace a semiconductor. Reducing treasury exposure does not replace the advanced chips that China needs to run its AI programs, its missile guidance systems, its telecommunications networks, and the manufacturing automation that sustains its export economy. The technology choke points remain the dimension of the conflict where the United States retains the most asymmetric leverage. American export controls on advanced semiconductor equipment, the ASML machines that print the most advanced circuits, the cadence and synopsis software tools that design them, represent a form of economic coercion that gold repatriation and treasury reduction do not address. China's parallel effort to develop domestic semiconductor capability, led by SEMIC and Huawei, is real and has made more progress than most Western analysts predicted. But it remains years behind the leading edge of American and allied technology, and the gap is being narrowed faster on the Chinese side than many expect. The financial repositioning buys time. The technology race is where that time is being spent.